This is Shelley Kraft coming to you live on SNN Live. We're at the Sprott Natural Resource Symposium 2016 in Vancouver. This person next to me is Rick Rule. He has something to do with this conference, ladies and gentlemen. He's from Sprott U.S. Holdings. Rick, welcome back to SNN Live.
As always, Shelley, thank you for having me.
Now tell us and the audience all about this conference and the smiling faces we're seeing.
Well, I would humbly suggest, Sprott puts it on, that this is the finest junior natural resource conference on the planet right now. It's been going on for 17 years, 3 years under Sprott stewardship. The paid attendance has grown from 360 to 700 this year. We have a wonderful range of exhibitors. One of the things that sets us apart from other conferences is that at most conferences the exhibitors are regarded as advertisers. Our attendees say that the exhibitors are content. The consequence of that is that any company that isn't owned in a Sprott performance fee generating account can't be an exhibitor at the conference. That doesn't mean that every stock is going to go up. What it means is that we know every exhibitor well enough that we own them. This franchise has worked very well for us. Of course, we have a wonderful range of speakers too, but many other conferences can offer that.
We've met and know many of the exhibitors that are at this conference. I would put this gold seal stamp on quality on almost every single one of them. But what's interesting is you've got gold, you've got base metals, you've got uranium, you've got the full gamut. Could you speak to that a little bit?
Yeah, absolutely. Sprott is known as a precious metals manager because of Eric Sprott's well-documented success in the bull market of the last decade. But the truth is, as a $10 billion manager, we manage across the spectrum of natural resources. My suspicion is that 2 years from now we'll be in a synchronized bull market, with precious metals leading but the industrial materials following on too. It's important for investors who just participated in 100 or 200% uplift in the junior exploration stocks with regards to gold to understand that the bull markets are contagious and they'll spread to other commodities too over time.
Well, I think that, as we say, gold seems to be the bellwether of resources.
I think that's correct. We haven't seen a strong enough economy, and I don't think we will see a strong enough economy to pull the other materials. Gold is different in that it's really a monetary metal, and the catalyst for the move in gold is obviously the zero interest rate and the negative interest rate environment, which simultaneously reduced the holding cost in gold by lowering the implied interest rate at the same time as it made the competing investment alternatives, the U.S. 10-year Treasury, much less attractive. The price leadership of gold goes back to the fact that gold is both a medium of exchange and simultaneously a store of value. Its utility isn't utility tied to the broad economy, but rather one tied to distrust of the financial services system and distrust of government, both of which are manifest today.
Well, you said earlier, which is true, the juniors are present in full glory at this conference. Also, they've lifted. At the end of the day, these juniors have the sun on the horizon, but what are the danger signs that investors have to look out for?
That's a great question, Shelley. First of all, these juniors are the best of the juniors. There's probably 1,800 publicly listed, allegedly junior mining companies in the world, of which some number, like 1,500, ought to go to company heaven. While the best of the best juniors do have the wind at their back, the best of the best juniors probably constitute 20% of the population of juniors worldwide. Two things for investors. The first is that a market that's up by 100% over 6 months, like this market is a market that needs a rest. The market's really getting frothy. People want to buy junior gold stocks without differentiating between the good, the bad, and the ugly. And I think that's very important to note. But the other thing is that we need to remember that the market, before it went up 100%, went down 90%. This is a market that fell by half, and then it fell by half. And then for good measure, it fell by half again. So the arithmetic is a market fell by 90 and has now doubled. So it's only fallen by 80. This is a market where the best of the best have a long way to go. Unfortunately, it's simultaneously a market where the worst of the worst go all the way to zero.
Notwithstanding that correction, there's also some of the non-performers in the sector based on the lower price of commodities, like the uranium companies, haven't had the bump yet.
Right.
As a matter of fact, since gold's gone up, they've still gone down further. Comment.
Absolutely, Shelley. And that's a very astute comment, too. The truth is that the rising market in gold and the rising attractiveness of gold equities has sucked money out of the rest of the resource sector, money that was already missing, as people were afraid to miss the run in gold and hence took money out of companies involved in other commodities. Companies, ironically, that probably have better risk-reward ratios than the gold companies. You remember, Shelley, because you were here, in the middle of the last decade, the most epic run we had in any commodity was in uranium. And we're setting up, I'm not saying we're setting it up for next year or even the year after, but we're setting up for a truly glorious run in uranium. At the beginning of the uranium bull market in 2002, there were 5 uranium juniors. At the top of the uranium bull market in 2006, there were 500 uranium juniors. Now we're back down to 10 uranium juniors. What I really like about the uranium business is that the stage is set sometime over the next 3 years for a doubling in the uranium price. When that happens, there is still a market memory of the incredible uplift that speculators enjoyed in the junior uranium stocks. And my suspicion is that the rush of capital into those stocks will resemble, as Doug Casey says, siphoning Hoover Dam through a garden hose.
My question to you is, we're both longtime guys in the market, right? There's a time to buy, there's a time to sell, but there's also a time to buy more.
Mm-hmm.
So the question comes when you've got a lift in the market in gold like it is, there's a tendency to, there's 3 things you can do, right? Mm-hmm. You can sell, you can hold, or you can buy more.
Right.
So what differentiates that consideration for investors at a time like this?
Well, Shelley, a hold is a buy, really. Any day that you don't trade a piece of paper for money, you bought. Hold is a misnomer. If a stock is selling for 40 cents and you don't sell it, you bought it for 40 cents. So I want to say that first of all. The second thing is that if you have a market where the share price is doubled with no underlying change in the value of the company, the stock isn't twice as attractive, it's half as attractive. I have been doing more selling personally than buying. I've been able to take most of my risk off the table with the junior gold stocks. Some of these stocks are up by 300%, and when something's up by 300%, if you sell a third of your position, you get the rest of the position for free. But what's much more important is stock selection itself. If you are an investor who wants to participate in the beta, that is, if you want to participate in the direction of the market, you probably shouldn't be investing in junior mining stocks. You should be investing in the Sprott Junior Gold Miners ETF. Don't confuse yourself. Don't make yourself do all the work. Participate in the whole market. If you want to do the work to get alpha, if you want to outperform the market, then by all means focus on the best of the best stocks. Very often, a stock that's doubled, if it's doubled for a real reason, is cheaper having doubled than it was before the reason took place and the stock went up. But you don't do this based on charts. You do this based on real studies, fundamental studies of the geology, the engineering, and the finances of the company.
So let's say, I'm sorry, you know me. So let's say on a technical basis, something that you bought, alpha, that you think is going to do very well, and it started to do very well, and let's say you're up 200%. Sometimes my training on the street was, well, buy more of that, because if you think there's going to be a lift in the market, you've got a chance to stay on something. Why not ride the horse to the finish line? I mean, if you're going to go switch around, sell that horse, pick up another horse, chances are you're not going to have the same fundamentals and the same technicals going forward. So why not ride something you already know if you're hopeful, secure, and like management?
I think hope is a 4-letter word. I really encourage my customers to get hope out of their vocabulary. This is a market that you can trade technically, but if you're going to trade it technically, you need liquidity, And you need to study the market itself as opposed to individual companies. For people who want to trade this technically, I can't emphasize this enough. Don't confuse yourself with individual stocks. Buy the ETF. Pay attention to the market if that's what you're speculating on. The ETF has so much more liquidity than the individual stocks. You can get on the market, you can get off the market, you can trade the market technically, and the technicals mean something because of the breadth of the market. One more time. If you're in this for beta, be in the ETF. Not any ETF, the Sprott ETF, a factors-based ETF. If you want alpha rather than beta, work very hard on individual stocks, not on markets.
So now I have to ask you the question of the day. We're heading into an election year. November's really just around the corner. I think you might have an opinion as to how that could affect the market for our investors.
Warren Buffett famously said, "The United States is strong enough despite its faults, to survive either Hillary or Donald." And I believe that to be true. I, personally, on pain of death, could not force myself to vote for either of them. I think they're both truly despicable human beings. I'm a securities analyst, not a political analyst. My suspicion is that Trump would do the least damage, not because of his policies, but rather because he's so roundly hated that Congress wouldn't cooperate with him. And the best I could hope for out of the current election is a Congress and a president that hated each other, that were able to accomplish absolutely nothing. Mrs. Clinton, who is less objectionable as a human being, is a completely vile, but unfortunately very effective politician. And I'm nervous about what Mrs. Clinton could do in conjunction with Congress. The fact that Mrs. Clinton could probably affect more harm, although Trump probably intends to inflict more harm, means that the lesser evil to me is the less competent candidate. But I wouldn't vote for either of them if my life depended on it.
However, there's always something that happens right before an election to markets. It's almost like I remember, in the day they said war is good for the street, right? So how does it affect the trading? How does it affect the CUM? How does it affect the Indu? I mean, you know what I mean.
Yeah. I suspect that indecision is good for precious metals markets, bad for general securities and commodities markets. So my suspicion is that the fears of the country club Republicans with regards to Hillary and the fears of whatever the other class is, the deep state, the elite of Trump, will take equity markets generally lower as a consequence of the election. The fact that the markets are going to have to choose between a swindler and a buffoon won't make anybody particularly happy. My suggestion is, with regards to precious metals markets, if either of those people becomes the icon for the United States, the face on $19 trillion in treasuries, that the faith that the market has in the treasuries represented by either of those despicable human beings will become less, and that gold will be a beneficiary.
I'll take you back to the conference now.
Yep.
You've got 700 plus. All investors, seemingly high net worth. What is the question that they're asking you? I mean, Go ahead.
Well, first of all, Shelley, you got to know that this crowd's not your average conference crowd. Most conferences are free, and these folks paid to be here. Most of these folks are accredited investors. They're here because they really want information about private placement investing. So this is a special crowd. It's a smart enough crowd that the most frequently asked question is, Rick, my portfolio's not up, it's way up. What could go wrong? The most frequently asked question is what could go wrong, which is a very healthy sign. Skepticism is very good for markets, and skepticism is a wonderful trait in a speculator.
These investors that I see walking around have a hop and skip in their step. It's been a dogged market. Things are going better. The companies are happy. They're excited. Investors are happy. Like the other guy that is asking you, Is there anything that could go wrong? I'm asking.
Market's frothy. Companies that couldn't raise money at 20 cents are raising money at 70 cents today. A company that's doubled or tripled with no increase in the underlying value is a company that is half or a third as attractive. The valuations in the junior sector are no longer cheap. The best of the best companies will continue because we're in a secular bull market, but there's a lot of money to lose in this market if you don't pay attention to stock selection. A lot of money to lose. And listen, you know this, Shelley. You've been around a long time. Markets don't go straight up. You have retrenchments in bear markets. They're normal, they're natural. In this market, it would be nothing to see it decline by 30%. The fact that people have been through 4 very bad years means that a 30% decline would be interpreted by some speculators as a head fake, that we didn't really have a bull market. And unfortunately, it's very common for people to get shaken out in these head fakes. It's weird that a declining market, which in a market for consumer goods would be called a sale, is regarded as a good thing when it has to do with suits, and a bad thing when it has to do with stocks.
So I imagine that there was cash sitting on the side, and that, in these 4 or 5 years of a down bear market, they took their cash and they sat on it until a time came where it lifted a little bit up on the hockey stick.
Very astute, Shelley. The world is awash in cash. Awash in cash for a whole bunch of reasons. Demographically, people are getting older, the successful people have saved. And when you do other things with your money, there's no return. When you and I were young men, Shelley, we'd open an account at a now extinct organization called a savings and loan, and they'd give us a toaster, and they'd pay us interest rate on our money. Now we go there, the savings and loan doesn't exist, the bank wants us to give them a toaster, and they want to pay you a negative interest rate. They want to do a situation where you give them $100,000, and 5 years from now they give you back $98,000. These depository products, guaranteed loss. My friend Jim Grant calls this return-free risk. Like, how attractive is return-free risk? The consequence of that and all this money printing, what you and I, if you and I did it, would be called counterfeiting. Mm-hmm. The consequence of this is that there's cash everywhere. We talk to these big institutions, and they have cash in amounts that is unfathomable. They have 2 or 3 zeros at the end of what we're normally seeing.
That's why there's overpayment.
You're right.
I mean, that's the way I see it. They feel like they're missing something.
And there's so much surplus cash. And I guess that's what makes the market frothy. That's something that scares me.
So now let's get more information out to our audience.
Right.
A couple of million people are interested to hear what you have to say as far as a website, so let's give it out.
Well, I'd love people to come visit our website. That's www.sprottglobal.com. We have a wonderful publication called Sprott's Thoughts. It's a periodical, which means we publish it periodically. We absolutely guarantee that your listeners and readers will get their money's worth because it's absolutely free. It's the best information from the Sprott universe and all of the people around the world that we're able to talk to and interview. And we'd love to communicate with your people more frequently at absolutely no charge to them. In addition, any of your listeners or readers who want to can always submit their portfolios, their natural resource portfolios, on a non-obligatory basis to us. All you do is email contacts@sprottglobal.com, send us your portfolio, both with the name and the symbol, and we will email back a no-obligation portfolio review. We won't review non-resource stocks, but all your resource stocks.
Rick, I want to thank you for having us. Lulu and I love coming to this conference. Bobby says hello.
Great.
And ladies and gentlemen, let's get the website one more time, if you would.
Yes, Shelley, thanks for supporting the conference all these many years. You can always reach us at www.sprottglobal, SPROTTGLOBAL.com.
Ladies and gentlemen, Rick Rule, Sprott U.S. Holdings. I'm Shelley Kraft. This is SNN Live, and we're coming to you from the confines of the Sprott Natural Resource Symposium 2016 in lovely downtown Vancouver. Rick, always a pleasure.
Thank you, Shelley.